Hello, everybody. I'm your host, Eric Bird, here at StopStrugglingNow.com. And today we have to talk about the stock market. A bad week? Well, is 2% down a bad week? What does this mean for you? Well, that means opportunity is knocking at your door. Do you want to receive residual income, passive income, otherwise known as dividend income at higher than 10% rate? Higher than 15%? Higher than 20%? Stay tuned, ladies and gentlemen, because we're talking about the markets and it's time for you to pay attention and welcome. Stop struggling now, gear. Check. And please like, subscribe, and click the bell below so you get the latest updates. Now, let's get to it. All right, welcome back, ladies and gentlemen. And once again, I want to thank you so much for being here. Please share the videos and get your pen, pad, and paper ready because if you missed the live streams and you've missed my last month's dividend investing stock information, I'm going to go over a few and add in additional ones because, again, 10, 15, 20% or more is possible once you put your money in on Monday. That's right. Now, not in the past. This is your future, ladies and gentlemen. So check this out. Let's just start off with the Dow Jones Industrial Average. Here it is. I want to point out this is the screen I'm going to have for each of the three indexes. Notice the 52-week high is 35. Notice the 52-week low is 31,400. They're closer to the 31,400. We're hoping this continues to slide down a little bit. And you're saying, Eric, why would you hope that? Because this gives you opportunities, ladies and gentlemen. So we will look at the S&P 500. Also, the 52-week high, 4,600 approximately. 52-week low, 36, almost 3,700. It's right there halfway in between, which means we're 50% at an L from the last 52-week high. This is a good position for you to be in. Look at this again. The NASDAQ, 52-week range, 14,446. 52-week low, 10,207. So 12,000 is right there in the middle, about 50%. We love that. How about the Russell Index? That's right, ladies and gentlemen. The Russell 2000 Index, 2007, 52-week high, 1,633 is the 52-week low, and it closed at 1,636. This is opportunity, ladies and gentlemen. And speaking of opportunity, here's how this works. It works like this as this scrolls around. This is yieldmaxetfs.com. Now, I want to explain for everybody that doesn't understand yields. When you want a return on your investment, the lower the price is, I'll put it this way. Let's just keep it simple. If you are getting on a stock, if you're getting $10 annually as a dividend, and the stock price is $100 when you bought it, $10 is 10% of $100. Now, that means your return, your yield is 10%. Now you can reinvest if it gives monthly dividends and things like that, but it's 10% basically. What happens though if the stock price drops to, let's just say, $5? Some of you would say, my God, I bought it at $10, and you'd be right. You'd be like, man, 50% is gone. But your annual yield would then be double. it would be 20%. All right? You divide $10 into the price of the stock, which is $50. I hope you are noticing the distribution rate on the right-hand side of the screen for all the different ETFs that they have by YieldMax. The reason I did that was because you can go and see these numbers are above what I was talking about at the intro. You can go look at what they've already given off for the dividends this year. So back to the equation so everybody understands. You divide the dividend that you receive, or the yield or return on your investment that you receive annually, divide that by the purchase price. And in this case, we're talking about stocks. This works the same way if you're getting a home or you're planning to do multifamily rentals. It works the same way. What you get as a profit, you divide that by the purchase price. So from $10 going down to $50 or $50, $100 going down to $50, that ends up being a difference between 10% and 20%. So here's the reason why I got excited when stock prices start sliding down and you start messing around with real estate investment trust or bank stocks such as JEPI. It is now at 10%. And they pay $5.23 per share this past year. Here's the thing, the stock cost about $52 right now. It has slid down a little bit. It could slide some more. That would mean the yield price would go up. So it does matter when you buy in or continue to buy in to stocks. If you want your free stocks from Robinhood and Webull, which you have not done yet, you haven't downloaded the apps, please go to the description box, look down below, and find the links to get the app. I'd greatly appreciate that. Next up, JEPQ, because their share price is around $42. All of this means you do your own due diligence. So, since they give out around $5.57 per share annually, their return on JEPQ is 12.28%. That's starting to be good, right? Now, let's start moving right along. PSEC 52-week high is $7.83, but now it's down near the 52-week low at $5. That means their yield is 14% annually now, and they give dividends every month. Along with JEPI and JEPQ, it's every month. But it's not 14% per month. This is an annual number. So they're only giving out, divide that number by 12. That's what you're going to receive every month. All right. For the money you put in today, because remember, stock prices change over time. At one point, it was $7.83, which meant the yield was at least around 7 or 8%. Now it's around 14, which is great. Now, you have to study these and make sure they don't stop giving out dividends all of a sudden. You have to do your own due diligence. MFA Financial, everybody here on podcast. M as in Mary, F as in Frank, A as in Apple. 16.9%, 16.09%. The stock price is $8.70. See, everybody can afford this. Even if you're doing 25, 30, 40, 50 bucks a week, at least you know you're getting somewhere in double digits for your annual rate of return for the money you're putting in now. And then put it in a reoccurring purchase. All right? So just keep that in mind. Now up, Dynex. $9.60. Stock is 16.25% annual return for their dividends. 52-week high, $15. 52-week low at $9.57. All of these are going towards that downside. But again, I caution you, oftentimes if they aren't making money, they may want to shut down their stocks, because remember, that's free money that they could actually keep in the coffers. So make sure you always study. Make sure you might even want to have a cost limit or cost loss on this, a limit for the loss on your account, just to make sure if it goes down to $9, maybe you want out or something like that, you know. I'm just saying, make sure you back your things up, because if they announce no dividends, I'm not saying Dynex, I'm just saying any company, their stock prices plummet before you'll know it. You'll be like getting an alert and it's already dropped $2, $3, $4 or something. So that's why I say that. NLY, NLA Capital Management, yes, $14.73 share price, 17.65% annual return on this dividends. These are mostly REITs. REITs are having a hard time right now because the loans are staying at the same level. The Fed is not reducing interest rates like they should have. They can't. They have to wait. And that means there's a holding pattern for another month or two. Now, AGNC starts the ball rolling at 20 percentile at $7. Their 52-week high was $12.25, and now it's down to the 52-week low is $6.98. They've hit that. 20%, 20.57%, ladies and gentlemen. This should start getting somebody a little bit excited as long as they stay around. But I got more for you. All right. I teased you with the yield max. To yield max is even higher than this, which is incredible. Do your own due diligence. Study these things. Make sure you want to invest because IEP is up next. The Icon Enterprises at $17.10. Guess what? This is a 52-week low. The people that shorted this stock about 3, 4, 5 months ago, they're happy. But you can be happy as well at 23.39% because they even cut their dividends and it's still this number. And it's amazing because automotive, food packaging, metals, real estate, and home fashion is all part of the Icon Enterprises group. This is interesting. So look at that. This is at its 52-week low. Can you believe it? So take a look at that. ORC, you guys have heard me talk about this for years. It has also dropped to its 52-week low, and it's giving out 23.84%. Unbelievable. Whatever money you put in, you could be earning that for the rest of your life. That's significant, ladies and gentlemen. Regardless of what inflation is, that is significant. All right? And last, second to the last but not least, IVR, Invesco Mortgage Capital. Again, 52-week low, it's pretty close, $6.34. The stock price is $6.51. That gives us a dividend yield of 24%, 24.58% at that stock price. Incredible. And last but not least, the star of the hour, which may not be the star, but it's Armor Residential REIT, ARR, and it's 35%. Again, double check everything because they are near the 52-week low as well at $13.57 is the 52-week low, and the stock price is at $13.68. Is this an optimal time for you to make investments into the stock market, ladies and gentlemen? I have to ask you the question. Make comments down below. I want to know. Because otherwise, you have no excuses going forward. You can take a risk and put your money there, or you can go put it in a bank, or you can put it under your mattress. It does not matter. But all I'm saying is those that will take a slight risk on some of these, all of these, however you want to do it, you are going to win at 15%, 20% for money you put in 2023. And then it could be 2027 and your money you put in is still earning 20-some%. And you're reinvesting it. Beautiful thing, ladies and gentlemen. And with all that said, thank you for watching. Thank you for listening. And please like, subscribe, and click the bell below so you get the latest updates. And I know it's hard out here, and that's why we have to come with making money work for you. Why do you have to work the 40 hours a week, then live paycheck to paycheck, and then figure out what to do next? Here's some of what you can do next. Put in that $25 a week or $50 a paycheck or $200, whatever you can afford. But you're going to have to get additional money from somewhere else. And with all that said, keep your head up, keep moving, and I'm out.